Jim, welcome.
Glad to be
Great
back.
Great to have the most successful short seller on the planet here.
It's a very low bar.
Anyway, it's been a great day for you, given what's going on with Tesla. I know you're short Tesla.
Yeah, as I posted earlier, to quote my favorite Simpsons character, comic book guy, most predictable breakup ever.
Awesome. Okay, so this week you issued a new short pick, and we want to hear all about it. Tell us what you're shorting now.
Yeah, so we still have advisory clients. We're not in the fund business anymore, but we do have some institutional clients. So we put out something early in the week on an old name of ours. So most of the people in this crowd, I suspect, would be very excited to find the next 100 bagger. So what we did was look for something that was already up 100 times and revisit it. So that company is Carvana, which has gone up 100x since its lows in late 22. And we think that it's still a misunderstood story. The street believes it's an epic turnaround. And we've been pointing out that, in fact, the company is still losing money ex gain on sale of loans. It's selling subprime loans to both affiliates and non-affiliates and booking big gains on that, representing 122% in the latest quarter of their income. And so it's a business that is, I think, misunderstood by the street. People are fascinated with the gross profit margins. The company excludes lots of things from its gross profit calculation that other auto dealers include. And so it makes the gross profit figure look great. And then people basically assume they'll leverage that figure. In fact, there's a lot of numbers in there that are scaling just as fast as the gross profit. But what really caught our eye and made it, I think, timely is a couple of positioning aspects, which these days on the short side are really important. Number one, the short interest is back down to multi-year lows from being one of the most heavily shorted stocks in the market in 2023. It's now back below and back toward its pre-COVID levels of short interest as a percent of shares outstanding, below 10%. But perhaps even more ominous is that the insiders have begun to sell in an absolute torrent of stock. And it's not just the Garcias, the chairman and his son, the CEO, but it's pretty much the C-suite are getting out seemingly as fast as they can. So again, I don't know what they see in terms of the near term. And the final thing I would point out to the audience is that although it's priced as a growth stock, at absolutely stunning price-earnings ratios and multiples to cash flow, the business is cyclical. Their used car revenues, their core business, dropped over 30% year over year from mid-2022 to mid-2023 when there was a slight slowdown in the economy. So this is really a company kind of at the end of the whip for retail consumers and trading at valuations that are just eye-popping.
So is the bull case that somehow the tariffs will hurt new car sales and everyone will turn to used car sales?
The tariffs will hurt new car sales. Carvana is still taking market share. Valuation doesn't matter. It's trading, I should point out, it's trading at 4 to 5x the valuations of its peers, including credit acceptance, which we think is actually arguably the best comp, which is another subprime auto credit issuer, because as I pointed out earlier, Carvana is making all its money in finance, not selling the cars.
So it's basically a subprime lender.
It's a subprime lender, yep.
Right. Is there a catalyst? Do you see a catalyst on the horizon?
Well, the insiders certainly seem to see one. They were very prescient the last go-around in 2021 and early 2022 when the stock dropped almost 99%. So this flood of insider selling all of a sudden in May is what caught our eye.
That's great. So you spoke to me about another big short for you guys, a thematic short, and it has to do with artificial intelligence. These are companies that you feel like are gaining from the artificial intelligence hype, but they're kind of future losers in artificial intelligence. Talk about them.
So to use the .com analog, and I know they're not exactly the same, but we had about 10 years of phenomenal shorts from, say, 1999 to '09, which was basically the reverse side of the coin of the .com and telecom boom. And these were companies that basically had analog business models that became digitized, and they couldn't adapt. So think of Yellow Pages, think of Kodak, Blockbuster Video. I mean, you guys can think of probably a few more. We were short almost all of those types of companies. We're doing our work now, and it's a work in progress, Matt, but we think there's a number of companies that kind of pop up that are going to be roadkill on the AI highway. And right now, similar to the early part and mid part of the .com boom, all the stocks are getting inflated.
Right.
But there are a lot of companies who have business models that, if you sort of think it through, are going to see them dramatically deflate because of the capabilities of AI as AI gets better and better. So, we call them either body shops or AI products that will basically be competed away. And again, we're puzzled by some of them because they're getting valuations similar to AI-type companies when even a cursory look at their business model says they could be in a lot of trouble.
So let's talk about some of those companies.
Well, I'm not going to give you a bunch of names, but one of our old names that is in that group that we've been short on and off since 2020 has been the IBM.
A big blue.
Which has been a good stock in the last year and a half. It's basically doubled, and after going down for 10 years. But it's trading back at all-time high valuations. It's not growing. It's a body shop. People kind of forget that. Just to give you an interesting comparison, as .com was exploding, but before the cloud and before AI, IBM generated about $280,000 per year per employee. That number today, 25 years later, despite all of the advances that IBM sells to its clients and talks about, that number is $230,000 per employee. So it's down $50,000 in this better part of 25 years. There would be no growth at IBM if it wasn't for acquisitions. So, I pointed out yesterday, for example, that a lot of IBM's customers are basically still using COBOL. Now, for those of you who know it, COBOL's over 50 years old. And there's now AI programs to basically rewrite COBOL for free. All the government agencies that IBM has as its contracts are using just antiquated software that IBM maintains for them. We think it's a business that's going to continue to melt away, not right away, but AI will continue to hurt IT consultants and IT body shops. There's others that you can think of that fit in that I'm not going to disclose that are somewhat obvious if you take that line of logic and say, well, who's doing consulting? Who's doing IT consulting? And what kind of products could be made obsolete by companies using AI, intelligent AI agents, to write their own software for task-specific things at their company? And the list starts to broaden out very quickly if you do that kind of thinking and analysis.
So all of these droves of young software engineers who might work at these body shops might have a kind of an ominous future. Yeah,
paradoxically, I mean, everyone was told to go into STEM and learn to program, and in fact, those might be the jobs most at risk.
Great. Well, Jim, thank you so much. We've got Carvana and IBM and IT body shops.
All right, I got to get back to Trump and Musk, see what's going on.